Before we dive in, hit subscribe so you don't miss new episodes. If you find value, click the like button so we reach more people. Let's get started.
Okay, imagine this. You got a significant investment portfolio, right?
Yep.
And you need capital, maybe quite a bit of it fast, but you really don't want to sell off your assets. I mean, who wants the capital gains tax hit or, messing up a strategy you worked hard on? What if there was a way to unlock that cash, keep your portfolio intact, and do it quickly? Sounds almost too good to be true, doesn't it? Well, today, that's exactly what we're diving into. Lombard loans. They're a pretty strategic tool that a lot of high net worth investors are using more and more. So our mission today is to really unpack what these loans are. Why are they so useful, particularly for high net worth individuals? And then we'll look at some real world examples, case studies from the UK, Europe, even the APAC region to see how they actually work in practice, how you turn static wealth into, well, something more dynamic.
Exactly. So at its core, a Lombard loan. It's basically a secured credit line, or sometimes a lump sum loan. But the key difference, the really important bit, is the collateral. It's not your house, like with a mortgage. Instead, you're using your marketable securities, think shares, bonds, investment funds. It's really a cornerstone product in private banking.
Right. It's designed to give quick access to capital while leaving those long-term investments alone.
Precisely. Keep them working for you.
Okay, so that's the what. But why this specific type of financing? What makes it particularly advantageous for high net worth folks? What's the strategic edge here?
Well, there are a few really compelling advantages. First off, just the sheer speed and efficiency. If you're already with a private bank and they hold your assets, these loans can often be arranged, remarkably quickly.
Which is crucial if an opportunity pops up that won't wait around.
Exactly, like a time-sensitive private equity deal or something similar. Immediate capital is key. Then, probably the biggest draw for many is preserving your assets.
Yeah.
You get the liquidity without selling.
No forced sales, no tax triggers.
Right. Your long-term wealth strategy stays intact. Your portfolio keeps generating returns, hopefully appreciating. It's about maintaining that strategic integrity.
Okay, that makes a lot of sense. What else?
Well, the interest rates tend to be favorable. Because the loan is secured against high-quality liquid assets, the lender sees it as lower risk.
Lower risk for them means a better rate for the borrower.
Correct. Compared to, say, an unsecured loan, the cost of capital is usually much more attractive.
And flexible too, I gather.
Oh, definitely. They can be set up as a flexible credit line so you only draw down what you need when you need it. Or it could be a fixed lump sum. And repayment terms can often be tailored. You might see interest-only payments with a single bullet repayment of the principal at the end. That gives a lot of cash flow flexibility during the loan term.
And just to touch on the UK context briefly, this isn't some Wild West product, right? It's regulated.
Absolutely. Here in the UK, it falls under the Financial Conduct Authority, the FCA. There's a solid regulatory framework ensuring transparency and protection for both sides, which is vital for these kinds of bespoke deals.
Good to know. Okay, theory's great, but let's see it in action. Case study time.
Let's do it.
All right, first up, a successful tech entrepreneur based in London. Portfolio around 15 million odd, quite diversified.
Yeah, and their objective was pretty specific.
Huh.
They wanted to jump into a £5 million private equity co-investment opportunity, but it was time sensitive.
Okay, so 5 million needed quickly. Selling assets was the obvious route, but
that meant a hefty capital gains tax bill. Plus, it would completely disrupt their long-term investment allocation, which they really didn't want to do.
so the challenge was getting the loan based on the whole portfolio. I remember reading a part of it was in less liquid stuff.
Exactly, some alternative funds in there. Their main private bank initially offered a loan, but it was based only on the easiest to value liquid stocks.
And that wasn't enough cash, and maybe not the best rate either.
Correct, on both counts. They needed a lender willing to do a proper deep dive, a holistic valuation of the entire £15 million.
So what did that involve? How did you get a better deal?
Well, it meant really analyzing everything in that portfolio, not just current value, but liquidity, performance history, how it all fitted together strategically. We then took that detailed picture to a panel of specialist lenders and private banks known for being a bit more flexible. We managed to negotiate with one who understood the bigger picture and was comfortable offering a higher loan-to-value, or LTV. They included more of those managed funds in their calculation.
So they lent more against the total value.
Precisely. And the £5 million was structured as a flexible credit line, fixed rate for 2 years. And the kicker,
Go on.
the whole thing, start to finish, funds available under 3 weeks.
Wow. Under 3 weeks for £5 million bespoke terms. That's impressive.
It really is. And the outcome, Client made the private equity investment, didn't sell a single core share, kept their main portfolio working. Win-win.
That really shows the power of speed and preserving assets. Okay, so that's one scenario. But you mentioned Lombard loans are useful for property too, right? How does that work?
Yes, absolutely. Especially for bridging finance in competitive markets. Let's look at our second case. This involves a multinational executive based in Singapore. They had a $10 million investment portfolio.
And they were buying in London.
Correct. Eyeing up a prime property in Kensington for £3.5 million.
Okay, prime London property, competitive market. I can see where this is going. They needed to act like a cash buyer.
Exactly. A traditional mortgage would have been way too slow, plus complicated given their non-resident status and international income. They needed funds fast to secure the deal.
So the challenge was speed again, but also navigating that non-resident financing complexity.
Precisely. But their $10 million investment portfolio was ideal collateral. The key was finding the right lender.
Someone comfortable with international clients buying UK property.
Yes, and experienced in using global portfolios as security for this exact purpose. We sourced a private lender like that. We arranged a $3.5 million Lombard loan against the portfolio, a conservative 35% LTV, which lenders like. It was set up with a 12-month term.
Just long enough to bridge the gap.
Exactly. And crucially, there was a clear exit strategy built in from day one. Get a standard buy-a-let mortgage arranged post-purchase and use those funds to repay the Lombard loan.
Smart. So how did it play out?
Perfectly. They secured the Kensington property, acting fast like a cash buyer. The Lombard loan gave them that speed and certainty.
And the exit?
Worked like clockwork. Within 6 months, the long-term mortgage was sorted, the Lombard facility was fully repaid and closed. It was a textbook example of using it as effective bridge finance.
That's fascinating. So private equity, property bridging. What about more complex planning, like tax strategies or maybe even passing wealth down generations? Can Lombard loans fit in there?
They certainly can. Which brings us to our third case study, involving the trustees of a UK self-invested personal pension, a SIPP.
Okay, a SIPP. Pension wrapper, lots of rules there. What was the situation?
The SIPP held over £8 million for a high net worth beneficiary. This individual wanted to gift £1 million to their children to help them buy property.
A generous gift. But pulling £1 million out of a pension, that sounds like a massive tax headache.
A huge one. Drawing that amount directly from the SIPP would trigger significant income tax. They needed the £1 million, but without that tax hit from the pension.
Right. And lending against a pension itself is notoriously tricky, isn't it? Very regulated.
Extremely. You have to be incredibly careful, ensure it's compliant, and always act in the best interests of the pension trust itself.
So how on earth did you structure that?
Well, it took close collaboration working with the client's own tax advisors and legal team. The solution was actually quite elegant. The loan wasn't made to the SIPP, it was made directly to the individual beneficiary.
Ah, okay. But secured against what then?
Secured against their separate personal investment portfolio, held outside the pension wrapper entirely. That portfolio was worth about £4 million.
I see. So the pension assets weren't touched or put at risk?
Correct. We arranged a £1 million Lombard loan against that £4 million personal portfolio. Because it was a low LTV, only 25%, we got exceptionally good interest rates. And the loan was structured with minimal repayment needs during its term, which helped their personal cash flow too.
That's clever. So the individual gets the £1 million liquid cash secured against their own non-pension assets.
Exactly. They could then gift that money to their children as planned.
And the outcome?
Success. The £1 million gift was made. No costly premature drawdown from the pension. The tax-efficient status of the SIPP was completely preserved. It really shows how Lombard lending can be part of sophisticated multi-generational planning, solving what initially looks like a real bind.
Okay, pulling all this together then, what's the big takeaway? It seems Lombard loans are much more than just, a simple way to borrow money.
Absolutely. They're really a sophisticated strategic tool for wealth management. As we've seen in these cases, they let high net worth individuals grab investment opportunities, access cash for big purchases like property, implement smart tax planning. And the key is, without having to dismantle their core investment holdings, it's about creating liquidity options within your wealth.
Right. But it sounds like getting it right isn't straightforward. It needs a tailored approach.
Definitely.
Yeah.
Success really depends on having a very clear idea of the financial goals, first and foremost. Then you need that deep dive analysis of the assets being used as collateral.
And finding the right lender, presumably, one who's flexible and understands these kinds of deals.
Crucial. You need access to expert lenders who can structure these often complex, sometimes time-critical facilities properly. Ultimately, it's about leveraging those existing portfolios, turning what might feel like static wealth, just sitting there, into a dynamic vehicle for growth and seizing opportunities, making your assets work harder.
It really shifts the perspective, doesn't it? When you see how these financial tools, if you understand them and use them strategically, aren't just products off a shelf.
Yeah.
They become powerful levers for achieving quite complex goals, things that maybe seemed out of reach initially. It really makes you think about the hidden potential within your own assets, doesn't it?
It certainly should. There's often more flexibility and power there than people realize.
Thanks for listening. If this helped or made you think, hit like it shows this content matters. And tap subscribe if you haven't yet. See you next time.